The global economy is firing on all cylinders. Growth is remarkably synchronized. There are risks. Again, the main risk to the global economy at this point in time comes from the US, and trade actions is taking there because they have the potential to spill over. So we're essentially going into this year with what had already been a very strong US economy, and we're layering on top of that a very significant amount of fiscal stimulus in the US, which leads to even stronger growth. So we're forecasting growth of 2.6% this year. Very, very strong. That's going to lead to higher interest rates in the US. We're anticipating another 50 basis points of tightening by the Fed this year. More to come in 2019. We have very strong growth in Canada this year, but growth that's significantly slower than it was last year. So in 2017, growth, Canada expanded by about 3%. We anticipate about 2.2% this year. So it looks like a significant slowing, and it is to some degree, but this is still growth that's extremely strong relative to the economy's underlying potential. So we anticipate 50 basis points of tightening in Canada this year, anticipate significantly more tightening in 2019 as the Bank of Canada acts to withhold kind of the inflationary pressures that are brewing and keep inflation close to its 2% target. So the governor has made it very, very clear that he thinks households are very indebted, and that as a result of that, any move in interest rates is going to have a greater impact on the economy now than it has in the past because households are more indebted. The word coming out of the US seems to be that they're more willing to get a deal. Progress is being made, negotiations are ongoing. There's a sense that we may have an agreement in principle within the next few days, possibly the next couple of weeks. So that's all very, very, very positive from a Canadian perspective. The challenge is that while we're making progress on NAFTA, we seem to be taking a pretty big step back on trade protectionism in general. So the United States is going very aggressively after China. China is responding. It's a bit of a tit for tat at this point in time. We're not sure how far that's going to go. So we're being a lot more concerned about this broader global trade risk coming out of the US to a very large degree. Trade wars are unambiguously bad for the countries that are involved in them. They lead to higher prices, lead to the exchange rate volatility. All that works to depress confidence, and it works to, most of the time, lower demand in the countries that are immediately in conflict, if you will. The US is the world's largest economy. China is the second largest economy. To the extent that they engage in a process that leads to weaker outcomes in both those countries, that's meaningful for us. It's meaningful for the entire world, but it's meaningful for us in particular given how closely we are linked to the United States.